Nowadays, it seems everyone wishes to time the market. When markets are at an all-time high, you're sitting before your screen waiting for it to fall. When markets have fallen, you're still sitting before your screen waiting for the perfect time to enter. This can be a very tense situation. After all, your money is at stake. But most importantly, there's something else that's also at stake. Well, it's your sanity. It depends on what side of the fence you're on, actually. If you're a trader that does this for a living and you possess the expertise required to manage your investors, it works very differently. But instead, if you're a working professional with a family to take care of and you have a set of hard-earned savings that needs to be protected, then I'm talking to you. Yes, I'm talking to you. We need to talk. As per SEBI's latest communication, 93% of people who invested in futures and options or traded in futures and options between financial year 22 to 24 lost money. And that's an average of at least 2 lakh rupees per person, which is a startling figure. That's significant, especially given that most of the investors were using their household savings, and India is a country which is developing. So should you be in front of your screen waiting for the markets to fall or go up? Or maybe do something else? Should you actually time the market? Should you time the market? If not, what else? By the way, I'm Adarsh, and this is the Finhancers midweek podcast. Let's talk. Meet Mr. Impeccable and his friend Mr. Unlucky. Both are working professionals. Mr. Impeccable is perfect at timing the market. He invests on all the best days of the market and avoids all the worst days. And his friend, Mr. Unlucky, who is unfortunate at timing the market. He attempts to time the market but ends up missing all the best days of the market. And just like this, over a 20-year period, starting from October 2003 all the way to October 2023, he misses around 60 best days in the market. So how did the both of them fare? And let's keep in mind that the both of them invested the same amount of money, which is rupees 1 lakh. And they invested in Nifty 500, which is the top 500 companies in India, over a 20-year period again. Now, if you look at the performance of both, as you can see here in this chart, Mr. Unlucky, who invested the 1 lakh over a 20-year period, missed the 60 best days in the market. These are 60 days when the markets prospered and he was trying to time the market but missed. And this 1 lakh would have hardly become 1.2 lakhs, which is just a profit of 20,000 rupees. That's assuming he missed all the best days. Now, on the other hand, you have Mr. Impeccable, who on the other hand didn't miss a single good day in the market, but avoided all the worst days. Again, what are the odds? He made as much as 48 lakhs. That is right. 1 lakh became 48 lakhs. But here's the thing. Is it really possible for us to get all the best days right? Is it possible for us to be there on all the best days and avoid all the worst days? That is very unlikely because we are not perfect. With that said, let's talk about something else. Let's talk about probably when Mr. Impeccable and Mr. Unlucky caught up with their good friend Mr. Consistent to discuss their investments and to find out how he fared during this period. And just for your information, Mr. Consistent doesn't time the market. Instead, he prefers to stay put in the market during the best and worst of times. Now here are the results. Rupees 1 lakh invested by Mr. Unlucky, as previously said, who missed the 60 best days over a 20-year period. 1 lakh became 1.2 lakhs. On the other hand, you have Mr. Impeccable, who made 48 lakhs on a 1 lakh investment. And then you have Mr. Consistent, who made 18.6 lakhs on a 1 lakh investment. Of course, well, Mr. Consistent fared way better than Mr. Unlucky, but couldn't beat Mr. Impeccable. So what does that mean? Does it mean you should follow Mr. Impeccable's footsteps? Well, it is clearly impossible, as we were just discussing. None of us can ever be impeccable. Not even the best traders and market experts can be Mr. Impeccable. After all, even Mr. Impeccable, who has made a lot of money, could become unlucky overnight and lose all the money he would have made, only if he mistimes the market. There is abundant research to support this as per the recent SEBI guidelines. It's come to our understanding that only 7.2% of individual traders in the futures and options market turned a profit over the last 3 years. Of these, just 1% managed to earn more than 1 lakh rupees after accounting for all transaction costs. Despite facing consistent losses, more than 70% of loss-making traders continue to trade in the futures and options segment, even after incurring losses in the previous 2 consecutive years. Further, timing the market could also lead to paying higher charges, brokerages, securities transaction tax, and taxes. It's very important that you keep all these factors in mind before you make a decision. Lastly, you should think about your sanity, because that's what matters the most. So is it really worth timing the market? That's a question you must ask yourself. And as a quick disclaimer, the figures that were displayed during the course of this video are for illustrative purposes alone. The idea is to spread awareness, get you to understand what's happening around you so that you can make a call that is suitable to you. I recommend you do your own due diligence, you do your research, you talk to people, you talk to an advisor, a qualified advisor if required, and make sure you keep these things in mind. And that's it for this week's episode of the Finhancers Pvt Ltd. I'll see you soon. Make sure to like, share, and subscribe to this video. And please do share your thoughts as well. And see you.